All right, I'm live on YouTube also, friends. Now, yeah, hi Pushpavali. Can you please share MCQ workings of previously that you give on mentoring day to cross check? Okay, Pushpavali, that workings of that I will give you as by way of a voice recording. Will that be okay? Thank you for the suggestion. I'll take care of that.
Hello, sir. Good evening.
Come again.
Good evening, sir.
Good evening, Mehak.
How are you, sir?
I'm good. I'm good. How are you doing?
I'm good, sir.
Okay, Sudha, this is a CA final session. You are a CA inter student. This is for CA final students. Okay, just WhatsApp me, Sudha. I'll give you my number. I will add you to the WhatsApp group if you are doing CA finals. Okay, right. Shall we begin now, friends? All right. So I'm sharing my screen. So as we always do, is start with the concept revision from the portfolio management mastery book. Okay. So here the principles of portfolio management. I always start my classes with this great personality, Warren Buffett. All right, so Warren Buffett is actually a person who has made a lot of money in the stock market. And one of the most important thing that Warren Buffett keeps saying is that we should never put all our eggs in one basket. We should always diversify our risk. Okay, diversification reduces your risk. That is the lesson number one, a very, very important lesson. Then we learned about what is a portfolio management. That's a place where you have multiple portfolios and you're using the entire portfolio over there. Actual return that is used or that's found out using the formula P1 minus P0 plus D1 divided by P0. One moment. There has been some alignment issue here. Okay, fine. So I think you're clear with this part now. P1 minus P0 plus D1 divided by P0 is the formula. So that's what they have used over here, right? After that, we learned they have given multiple concepts, examples over here so that you get better grip on the entire thing. Second part is standard deviation. Friends, standard deviation is nothing but it is a deviation from your mean or deviation from your average. The table format for standard deviation is x, p, x minus x bar, p into x minus x bar, the whole square. Okay. So once you do that, you get a probability or you get a diagram like this, which says that if your marks are 189 and it is going to be a 20%, 20 standard deviation, your actual marks will range between 169 and 290. This is having 70% probability. Above 219, 15% probability. Below 169, another 15% probability. Okay. Then we learned about covariance and correlation. Covariance is nothing but x, y, p, x minus x bar, y minus y bar, p into x minus x bar into y minus y bar. All right, that will give you the combined variance of two securities. Then we learn about correlation coefficient. Correlation provides you the relationship between two securities. So if they are moving in the same direction, it will be positive. Opposite direction means it will be negative. The formula for correlation is covariance of xy divided by standard deviation of x divided by standard deviation of y. Everybody clear with this part? Sudha, you can just WhatsApp me. I'll get back to you. Next, we learned about. They've given a lot of examples here, friends, so that you get grip on what exactly is covariance, what is correlation, etc., etc. Perfect positive, perfect negative correlation. As I told you, if they move in the same direction, it is positive relation. If they move in the negative direction, it is negative correlation. All right. Yes. Fine. Next, let me go to the next part now. Okay, let me go to the next part. Then they learn about combined return. Combined return is nothing but return of x into weight of x plus return of y into weight of y. It's basically nothing but the weighted average return. Then we learned about combined risk. That is not a weighted average risk. Here we do it using Markowitz formula. That is a plus b the whole square. Or in other words, standard deviation of x, weight of x, the whole square plus standard deviation of y, weight of y, the whole square plus 2 into standard deviation x, standard deviation y, weight of x, weight of y, correlation of x, y. Everybody clear with this part? Okay. Now, let me come down.
Sir, that formula, Markowitz formula.
Come again.
Markowitz formula, sir. No, Markowitz method formula. Go up, no?
Okay. Okay.
Standard x, weight of x whole square, standard deviation y, weight of y whole square, 2 into standard deviation x, standard deviation y, weight of x, weight of y.
Okay,
Right?
okay. You're trying to say there's a weight of x missing over here, is it? Thank you so much for
Yes,
letting
sir.
me know. I've noted it down. Okay. Thank you so much. Right. Can I go to the next part now? Let me come down. So after we learned about combined risk, next thing that we have to learn over here is matrix method is not there in your textbook, but it's a logical method which I wanted to share with all of you. Okay. Let me go to the next one. Principle of dominance. If two securities have the same return, select the security having lower risk. If two securities are having same risk, select the security having higher return. Beta. Beta tells you for every 1% change in the market, what is the change that is happening in the security. All right. Yes. One moment. I think we have reached almost the limit. I'll just share the YouTube link with all the students, friends. All right, let me continue now. So as I told you, beta is what? Beta is nothing but for every 1% change in the market, what is the change happening in the security? Beta can be found out using three formulas. Formula number one is standard deviation of sigma xm minus n into x bar m bar divided by sigma m square minus n into m bar the whole square. Formula 2 is covariance of xm divided by variance of m. Formula 3, standard deviation of x divided by standard deviation of m into correlation of xm. Formula number 4, change in security divided by change in market return. Using any of these formulas, you can always get the answer. Next part. Then they have given you a lot of conceptual easy questions so that you can apply the same and learn the concept of beta. Then we learn about CAPM return. The full form of CAPM return is Capital Asset Pricing Model. As per the CAPM return, the required return is nothing but it is RF plus beta into RM minus RF. So where RF is the risk-free, beta is the fluctuation, then you have RM minus RF, where RM is nothing but the market return and RF is the risk-free. So what they're trying to tell you is that if RM minus RF is your risk premium, so if my risk premium is 5%, beta is 2 means my security is double risky compared to the market. So I should have a double risk premium. This double risk premium along with RF should be my required return. Are you all clear with this part now? Sukesh, you want me to elaborate the first formula of beta, is it? Yeah, Sukesh, that's basically they're trying to tell you how much is the change in the security for every 1% change in the market. I will explain to you. It's a derivative formula where you take sigma xm. So xm is x with that of the market. Am I right? N into x bar, m bar is basically nothing but number of outcomes into x bar into m bar. So you're trying to take xm on the numerator and m market as a denominator. So what happens is when you do this, you get the market nullified and you get the proportion of x to m. That is actually the logic of this formula. It is basically to try to find out for every 1% change in the denominator, how much is going to be your change in the numerator. All right. Yes, let me go to the next part now. All right. So we learned about CAPM return also, correct? After CAPM, the next thing is security market line. Friends, security market line is nothing but it is the graphical representation of CAPM. So when you put CAPM in a graphical format, it is called as something like this. This curve is what we call it as a security market line. So now, when you talk about security market line, in exam, you cannot give a graph. So instead of giving a graph, what we do is we'll put the equation in such a way that we will keep the beta alone as variable and the remaining numbers will be provided over there. Everybody clear? Thank you, Venkat. Thank you so much. Okay. So that is how you actually find out the security market line. Everybody clear with this part? Then we learn about three types of return: expected return, required return, and what is the last one coming over here? Actual return. Friends, expected return is nothing but sigma of outcome into probability. You can have various outcomes and you can have various probabilities. So this is nothing but sigma outcome into probability. Required marks is the mark that you should get. So when you talk about the required marks, it is basically how much you should get. That is found out actually using CAPM return. But sometimes they give CAPM without RF. If you are given CAPM without RF, what do you get over there? You get beta into RM. Everybody clear with this part now? Last one is your actual return. Actual return is nothing but P1 minus P0 plus D1 divided by P0. So look over here, expected return, outcome into probability. Required return is RF plus beta into RM minus RF. All right. Actual return is P1 minus P0 plus D1 divided by P0. Everybody clear with this part now? Expected, required, actual. Everyone clear with this part now? Just a moment. Okay. All right. Yes, friends. Shall I go down now? I'll go to the next part. Next return that you have over here is called as alpha. So friends, alpha is nothing but it is the excess of expected return over what? Required return. Everyone clear with this part? So alpha is nothing but excess of expected return over required return. If alpha is positive, what are you supposed to do? You are supposed to buy. If alpha is negative, you are supposed to sell. Everybody clear with this part now? Right? Next one. After alpha, let's go and learn the next part. They have done a lot of questions over here, which you can work out yourself. Characteristic line. Friends, just like security market line was a graphical representation of CAPM, characteristic line is going to be a graphical representation of what? Of alpha, where RM will be kept as variable. So this is the equation. Alpha is equal to expected return minus beta into RM, where they will keep RM as a variable factor. Is everybody clear so far? YouTube students, are you all comfortable? If you have any doubts, please do let me know. Okay. Right. One moment. Okay. I can now see the YouTube chat also. Yes, tell me.
So just one doubt. In this alpha, when you do expected return minus beta into RM, we are supposed to consider the beta of the security even when we are calculating the alpha for the market.
Alpha is never found for the market. Alpha is found for the security only.
Oh, okay. Because there was one question I saw in ODBE where the market detail was given. And for that also alpha was found.
I don't think so. I don't think you have found the alpha for the market. No, that's not possible. Just cross check again. You're talking about that aggressive security and the market, is it?
Yes, sir. It was given as security A and market in the question. But in
Right.
solving, it was taken as security
No.
A and security B and solved.
Okay, I think there is a correction over there. Actually, the question there was A and B was there, but both were having same adjustment. So I removed the B from the question, but I think in the solution that B answer has come up. Okay, that is why you got that confusion. So ignore that B part. That is not market. Okay, that's not market. Just ignore that part. All right. Yeah.
Okay, sir.
All. Yes, friends. Can we continue now? Okay. So now once you're done with this, you have an expected return. And this is the graphical representation of characteristic line. Okay. Right. Now we learn about two types of risk: systematic risk and unsystematic risk. Systematic risk is also called as non-diversifiable risk. Unsystematic risk is also called as diversifiable risk. Total risk consists of two parts: diversifiable risk and non-diversifiable risk. So total risk is found out using standard deviation, whereas diversifiable risk is the balancing figure. Non-diversifiable risk is found out using the formula beta of x into standard deviation of the market. Why it is done like that is because standard deviation of the market is nothing but non-diversifiable risk. Correct? So when you take the non-diversifiable risk of the market and you multiply with the beta of the security, you end up getting non-diversifiable risk of the security over here. Everybody clear with this part? Yes, let me go down now.
Excuse me, sir.
Yeah, tell me.
Sir, could you
Your
please
voice is breaking.
explain
Wait. Your voice is breaking. Indra, your voice is breaking.
Sir, could you hear me?
Yeah, it's clear now. Tell me.
Sir, could you please explain the non-diversifiable risk again?
I will explain. You please interact with me. Tell me what have you understood in non-diversifiable risk so that I can elaborate and explain to you the remaining part.
Sir, the last one, when we multiply beta into the with the market rate, we'll get the securities non-diversifiable risk.
I will explain that.
That part
What
again.
happens over here is when you're trying to find out the non-diversifiable risk, the formula what we are using over here is standard deviation of the market into beta of the security, correct? So when you speak about standard deviation of the market, this is nothing but this is non-diversifiable risk of the market because market is fully diversified. Okay. So when you multiply this with the beta of the security, you end up getting the non-diversifiable risk of the security. So let us say this is 10 and this is 2. I get the answer as 20. The logic of 20 is that non-diversifiable risk of the market is 10. My security is double risky compared to the market. Hence, my security's non-diversifiable risk will be how much? It will be 20. Indra, are you clear now?
Yes, sir. Thank you, sir.
Thank you. Thank you so much, Indra. Can I go to the next part now, friends? All right. Okay. These are all examples. Combined beta of more than one security. All right. Friends, if you want to find out the combined beta of more than one security, you just have to take the weighted average beta. Beta of x, beta of x, beta of y, and so on. Okay. Next one. Different types of beta. So friends, there are basically, if you look at the balance sheet over here, you have 4 types of beta. This is what we call it as the asset beta. This is the beta of the asset. This is the beta of the equity. This one is the beta of the debt. And this is what you call it as beta overall. So beta overall is nothing but it is equal to beta equity into weight of equity plus beta of debt into weight of debt. Everybody clear with this part? So this is how we work out the overall beta for a particular security. Beta overall is equal to equity into weight of equity, debt into weight of debt. That is beta of asset into weight of asset plus beta of asset B into weight of asset B and so on. Okay. Now from this, we can find out a revised formula for beta equity where instead of putting weight of equity, I will put E divided by E plus D. And whenever there is debt, on the debt, you will have to pay interest. Whenever you pay interest, you have a tax advantage coming over there. So they will make that 1 minus tax advantage over here. So the equation will become beta equity into E divided by E plus D into 1 minus tax plus beta of debt into D into 1 minus tax divided by E plus D into 1 minus tax. Is everybody clear with this part now, friends? Yeah. Can I go to the next one now? Right. I think once you're clear with the revised formula, I'll go to proxy beta. Friends, when you want to find the beta of any unlisted company, you can do this by using proxy beta. So when you go for proxy beta, over there we have to go by 4 steps. So let's say if I want to find out the beta of one particular gold
Hello?
company? Yeah, tell me.
Sir, one doubt, sir.
Yeah, tell me.
Sir, in the previous formula, you did the D into 1 minus T, right?
Correct.
Usually, you reduce the tax component from the interest only, na?
Exactly. Okay, you have a very good point. I'm speaking to Brinda.
Yes,
Okay.
sir.
Brinda, let me explain to you in a different way. What you said is right. Okay. Now, how do you find out the value of debt? Or can I say KD is equal to interest into 1 minus tax divided by P0?
Yes,
Have
sir.
you learned this formula in your CA inter classes, right?
Yes, sir.
Okay. So can I say P0 is equal to interest into 1 minus tax divided by KD?
Okay.
Right? Okay. Now let us say my interest was 10 rupees because my debt was 10 percentage. Correct?
Okay.
Okay. Now there is a 30% tax advantage coming in. Correct?
Okay.
I will divide it by my KD is how much percentage? 10 percentage.
Okay.
So 7 divided by 10 percentage when you do I get the debt value as 70?
Yes, sir.
But originally the debt value was actually how much? It was 100 rupees. Correct?
Okay.
So when
Okay,
I
sir.
do into 1 minus tax, I get 100 into 1 minus 30%. You get the answer as 70. That's what we're doing over here.
Okay. Okay, sir. Okay. Thank you. Thank you.
Got it? Yeah. All right.
Okay.
Fine. So friends, when you try to find out the beta of, let's say, of a gold company, you will try to go to the stock market to find out any other gold company that is listed. So in our example, we can say that Kalyan Jewellers is listed. So I'll have to go and do step number 1, beta equity of Kalyan Jewellers. Step number 2, beta overall of Kalyan Jewellers. Step number 3, whatever is the overall beta of Kalyan Jewellers will be the overall beta of this particular company. From that, we can go and find out the equity beta of this particular company. These are the 4 steps involved in finding the proxy beta. Everybody clear with this part now? Okay, 1 minute. Yes. Shall I go to the next part? Okay. Fine. Friends, then they are giving you to find out the formula for KE. So when they are asking you to find out, yeah, Sukesh, I'm reading a message now. Exactly, it is geared and ungeared beta. That's what we call it as levered and unlevered beta also. Okay. So KE can be found out using the CAPM formula. That is RF plus beta into RM minus RF. Everybody clear with this part now? So that's nothing but that is the, equity beta formula. KE formula, sorry. So once we are done with KE, I'll go to the next part. They have given you some examples here. After every concept, they'll give at least 2 examples. Then we learned about arbitrage pricing theory model formula 1. This formula says the equation should be RF plus beta into RM minus RF plus beta X inflation into RM of inflation minus RF plus beta X GDP into RM of GDP minus RF and so on. Like this, one more fellow came, arbitrage pricing theory model formula number 2. For him, the formula will be RF plus beta of inflation into actual value of inflation minus expected value of inflation plus beta of, let's say, what else? Forex into actual value of Forex minus expected value of Forex and so on. Like that, they find out the formula. So there are 2 equations. One is RM minus RF, other one is actual value minus expected value. Then friends, we found out a new formula for calculating covariance. That is nothing but beta of X into beta of Y into variance of the market will give you what? It will give you your covariance of XY. Okay. Next part. After that, we learned about, it's a very long chapter, how to find out the proportion at which your overall risk is going to be minimum. So to do this, we can use the equation covariance of XY weight of X is equal to variance of Y minus covariance of XY divided by variance of X plus variance of Y minus 2 covariance of XY. Okay, so by doing so, you get the answer as 50% in this example. Yes. Okay. Then we have done a question on how to find out the minimum risk in case of 3 securities. In case of 2, we can use a formula. In case of 3, we go by a linear equation. Then we learned about short selling. In normal cases, we buy first, sell later. But in case of short selling, you sell first and then you buy later. Then we learned about two-factor model where you'll have beta xm into weight and beta xi into weight. So whenever you have a short selling, the weights will become negative. Whenever you have a borrowing, also your weights will become negative. Risk premium and return premium are almost exactly the same. Okay, then friends, we have a concept called as how the index is formed. It's not a part of your syllabus. It's just for explaining the logical part of how Nifty 50, BSE 100, etc. operates. After that, we started with the additional practice question. And then we have done a lot of questions here, friends. I think, let's check how many are there. We have 43 questions in this chapter, friends. This Forex together will be having 100 plus questions, friends. And derivatives, we will have around 150, 200 questions. Right, friends, so I have covered all the conceptual part. Now we will go to part number 2. Can we go and check what is the status of the assignments right now? We have 470 students enrolled for the mentoring batch. Out of the 470, let us check where the assignments have reached. The first assignment of security valuation, we started with around 400 plus students. Out of that, right now, if I understand, we have got total 105 people who have submitted the assignment. Remaining haven't done it yet. Friends, 2 weeks are over. By tomorrow or day after tomorrow, you will start getting message from my side if you haven't done the assignment part. All right. As far as portfolio is concerned, I don't think anybody has submitted, but we still have time. The due date was given as how much? On what date you're supposed to complete? 20th. So today is only Monday. You have 2 more days time. Can you please complete it by Wednesday or Thursday and get back to me on that part? Yeah. Please do all the assignments by March 31st. Finish your assignments. April 1st onwards till April 10th, you will have 3 mock exams and 3 MCQ. With that, by April 10th, you are ready for the exam. If there is something left out, you can take it as a buffer time to study it. After 10th also, you still have 20 days of buffer time. But coming May 2025 examination, I request you all, please work with me. Let us score 70 plus in the upcoming AFM May 2025 examination. Now, friends, shall we go to part 3 where I'll clear all your doubts on the chapter of either security valuation or portfolio management. Okay? Yes, start asking. I'm waiting over here. No doubts?
Sir, I just have a generic doubt if I can just start it off.
Definitely, you can ask me. Yeah.
Sir, we saw 3 formulas for the beta, no, sir, beta calculation. In
Yes.
that, can we use any formula? So, for example, there were questions where there was also details related to the security and the market given. So, we could have used the first formula. We could have also used the covariance formula. So, if we can use both formulas, which is the formula we should be approaching, sir?
Yeah, very good point. Let me give you a summary chart for that. 1 minute. I'll just open my notepad. Okay, 1 moment. See, what happens is, whenever in the exam, if probability is not given, okay, we can use formula 1, we can use formula 2, we can use formula 3. But in the exam, if probability is given, all right, you cannot use formula 1, you can use either formula 2 or formula 3. Now, if only 2 outcomes are available, in that case, you just have to go and use formula number 4. That is change in security return divided by what? Change in the market return. So this is the three ways of working around. Are you clear now, Shivani?
Yes, sir. I got it now. Thank
The best one would be when you have multiple outcomes. If you see, formula 2 is universally acceptable.
you. Okay.
And when you have two outcomes also, you can use formula 2. Okay. Here you can use all formulas, but when two outcomes are there, it's easy to use formula 4. It will get over quickly.
So
Alright.
do we have some sort of marking that, determines that if we use this formula, it's better, something like that, or it's just common sense?
Formula 2 is always better. You'll never go wrong.
Okay. Okay, sir.
Okay.
And I have one more specific question, sir. Can I ask now?
Yeah, please.
Yes. In question 14 of ODBE, sir,
Okay.
there is one calculation that comes where the formula is supposed to be PD square, no, sir. For calculating the variance of the portfolio, we usually do sigma PD square, but in this case, it's done as sigma P square D.
Let me
I
check.
don't know if I
ODBE book. Let's check.
Yeah, ODBE book. ODBE book and question number 14.
Question number?
14, 1-4.
Okay, in question number 14.
Yes. On page number 30, the first line is there. The next page. Yeah, if you can, I think a little above.
Okay.
Yeah, this one. First line, 0.0134 into 0.2 square. That 0.2 square is actually probability.
Okay, understood.
given
Okay, what
the
you can do is
question,
instead, I'll tell you a different way. Take your calculator.
Yes, sir.
Just take 0.0134.
0.134
That's the variance. Do a square root.
square root. Okay.
You got the number. That is the non-diversifiable risk. Okay. Do into 0.2. Into 0.2.
Twice, sir, into 0.2.
No, only one time. Into 0.2. Only once. Okay, you
Okay.
got an answer. Whatever answer you can take a square of that.
Okay.
That whatever the same answer you will get if you do 0.0134 into 0.2 the whole square. So basically what they're doing over here is, okay, it is ideally, hold on, it is ideally NDR of X into weight of X the whole square. This can also be shown as NDV into weight of X the whole weight of X square. Both are the same thing. That's why they have done it like this over here.
Okay. So had this been standard deviation, we would have done the whole square.
Exactly.
What is
Standard deviation into weight, the whole square is what we have done over here.
Okay. Right.
Got it?
Okay.
Yeah.
Fine. Thank you.
All right. Okay, fine. Thank you. It's not NDV, I think it is DV. Diversifiable risk is what they are done over here. Correct?
Yeah, unsystematic. Yes. Yes.
All right. Yeah.
Yes.
Shivani, I think
Thank
you
you,
have
sir.
attended my class, right?
No, sir.
All
I'm
right.
only attending the session.
Okay. Fine. I think in my class I've given a separate chart. So I thought you are familiar with that. That's fine. Okay.
Right.
You
Okay.
can do it this way. You'll get the same answer. All right. Okay.
Right. Yes. Thank you so much. Thank you.
Thank you, Shivani. Any other doubts you have?
Sir, I have a doubt.
So thank you. I'm done.
Thank you so much. Yeah, tell me.
Sir, in mastery book, question number 9.
Okay, 1 minute. Let me take that question. Okay, YouTube students, if you have any doubt, please ask me now. Okay, write down all your doubts. I'll clarify only then we'll pack up today's class. Mastery book, is it? Wait. What is the page number? Can you please tell me?
Sir, 530.
530. So, 1 minute here. I have only 174 pages. They would have given the page like that, is it?
Yes, sir.
But it's changed now. It's made 5.1 and I think we would have bought a little earlier the book then.
Sir.
Question number 9, right? Practice
Yes,
question
sir.
number 9, correct?
Yes, sir. Yes, sir.
Okay, this one, right?
Yes, sir.
Okay.
Sir, in this question, they are asking to find out the beta.
Okay.
And I tried to solve using formula number 1.
Okay.
When I checked the solution, my answer was different from the solution using formula number 2. The solution is given using formula number 2.
What was the difference that you got? Can you tell me?
Sir, I got 1.61 and the answer in the solution is 1.03.
1.61. Yeah, that's covariance that you have got. Covariance is 1.61. Have you done it correctly? Because nobody else has asked that doubt. Wait, this is the market. Deviation of the other one. Deviation into RA into deviation into RM. This 4.83 you would have got 4.83 and RM square 4.67. Wait, okay, I'll explain to you. See, there is no probability given over here, right, Arsha?
Yes, sir.
So when you took the total, did you divide it by 3 to get the simple average? How much is the covariance of AM that you got over here?
2 point covariance. Sir, I used the formula number 1.
Formula number 1 is what you used, is it?
Yes,
You
sir.
should get the same answer. Somewhere you have gone wrong. Did you try using formula number 2?
Yes, sir. I tried using formula number 2 also. I got the right answer as given in the solution.
But when you did formula 1, you were getting something else, is it?
Yes, sir.
That is not possible. Did you take weighted average or simple average? It's only no weighted average. You can take only simple average over here, correct?
Yes, sir. I took the simple average. I got the simple average as 10.33.
Okay, okay. I'm not sure why you have got it
Sir,
that
a
way.
similar thing happened to me also when it was a different sum, I think, but when I tried with formula 2 or whatever the
Okay,
formula the question was using, I could get
okay.
the same answer. But when I used formula 1, the answer was a slight variation was there.
How much? But in her case, she's saying there's a big variation. Ideally, that should not happen, Aksha, but I'm not sure how to cross check that. I'll have to work it out. Just WhatsApp me. We'll
Okay.
check that part. Okay.
Okay, sir. I'll do it once.
Maybe I'll just check
more.
formula 1 and I'll see if you've done any mistake in that or no. I'll check and get back to you on that part. All right.
Okay, sir. Okay.
All
Thank you.
right. Fine. Thank you. Thank you so much.
Sir, I have
How
one
much
more.
would be a tolerable variation, sir? Around 1%, 2%? How is that?
It's all based on judgment. Materiality concept has to be there. I think according to me, 2% is a tolerable variance according to me. Okay.
Right. Okay. Okay,
Sir,
All right.
can you please take question number 14?
1-4, is it? Wait.
Yes,
Many
sir.
students have sent message. I'll get back to all of you. Okay. Don't worry. Just wait there. I'm just clearing the oral doubts first. Then I'll go to the message based doubts. Question number 14. Okay.
Yes, sir. Here, I didn't understand why we took RF using 7 divided by 140.
I'll explain to you why we did it that way.
Yes,
Here,
sir.
140 is the market price, correct?
Yes, sir.
7% is the coupon rate. Coupon rate comes on what? Does it come on the face value or the market price?
Face value.
It comes on the face value. And how much is the face value here? It's only 100.
Okay, sir.
So on 100, when you get 7% means I invest 140, I get 7 rupees. So
Sir.
my RF is 7 by 140. That is equal to, I think, 5%. This is the logic.
Okay, sir.
Got it? So you would have assumed RF to be 7% because you
Yes, sir.
thought that it is 7% is the return. But no, 7% is on the face value, not on the market price. All right?
Okay, sir. Okay.
Yes.
Sir,
Tell me, friends.
hello.
Yeah, tell me.
Sir, that beta, now a person said no, sir. It's like ODB question number 2, in that only we are getting the difference, I think.
Question number 2, you're getting difference because, wait. Question number 2 is which one? ODB book, is it?
Yes, sir. Because in that we are, if we calculate using covariance by variance, that formula, we are getting 1.91. But in that book, they are
ODB or mastery book? Which book are you talking about?
ODB.
ODB question number 2 is dominance theory.
1 minute, sir.
Are you talking about question number 3?
No, sir. In that, at the additionally 2 problems would be there in the ODB book.
Okay.
At the last.
You mean this question?
Yeah, yes, sir.
Okay. So in this question, what is the issue?
In this question, they have solved using a formula, which is actually a statistics formula. So, but if we calculate using covariance by variance, then we are getting 1.91.
They have used the xy square, okay? But you will get the same answer using covariance also. You would have done some mistake. Just share an image with me in WhatsApp. I'll get back to you maybe in 1 or 2 days of time. All right? You should get
Okay.
the same answer. You will not get different answer. I have cross-checked. I have done multiple questions where there are no probabilities given. You will get the same answer only. There's some error in your end. Okay?
Okay, sir. Fine. Thank you.
All right, fine. Yes,
Sir,
friends. Any other? Yes, Niveta, tell me.
question 36 in mastery book, sir.
Question
Page
number 36 in mastery book. Page number?
5.162. In solution part, I was not able to arrive at the R, the second column.
Wait, let's check.
Return percentage, yeah, 4.34. So how did you arrive those values?
1 minute, let's check. R means you're talking about this deviation, right?
Yeah.
Slight alignment issue is there. Okay, 1 minute. Let's check here. You got, did you get this minus 18.33, etc.? All this part is clear?
Yeah, those were clear. So only this 4.34, those values alone I have doubt.
Where is 4.34?
In second column only, so that R percentage.
This is the deviation from the average. 19.6, 18, 33, 42, 43, 44, 34. What is the average that you get over here? 13.99?
No, sir. I think if you add up all these, you'll be getting 237.01.
Divided by a number of outcomes, 7. Just do it now and tell me.
Sir, I think in this sum, we don't do by 7, we do by 6. It's from 18.75 to 34.75. We don't consider
Okay.
19.
So how much do you get when you do that?
Sir, actually, this is written computation, sir. P1 minus P0 divided by P0.
Okay, R is return. Okay. All right.
We cannot directly apply probability on the market price, like, so we have to compute return only. That's why return is find out.
Okay, so this is all returns, is it? Okay.
Yeah,
That's why you get minus 4.34 in the first case. All right. Okay. So
Yeah,
I think instead of giving R, we should give a heading properly as return. Otherwise, it's creating confusion over here. Correct? Yeah. All right. Yes, friends. Now, any other doubts, friends?
Sir, question number 28.
28. Page number?
Sir, in my book, it's 561.
That's okay. 28, right?
28, sir.
Beta.
Okay. Yeah.
Sir, in that working out that standard deviation of the portfolio, there
Okay.
is no
First
formula.
thing, this is nothing but this is diversifiable risk. Okay. Second thing, this question is solved using sharp index model. These two base, if you don't get, you will get confused.
Okay, sir.
With whom am I speaking to?
Arsha, sir.
Arsha, have you attended my class on sharp index model?
Yes, sir. Yes, sir.
You remember that chart that I gave you that you have two parts, diversifiable risk and non-diversifiable
Yes,
risk?
sir. Yes, sir.
Okay, NDR is on an overall basis, diversifiable risk is on an individual basis, correct?
Individual basis. Yes, sir.
Okay, keep that theory in your mind and then you work it out, you'll get correctly the same answer.
Okay,
That's
sir.
why you must have suddenly found this question a little tricky. Understood? Okay.
Okay, sir. Okay.
Okay, so look at this. They have taken the overall this thing, diversifiable risk of A into weight of A plus B into weight of B. Like that, they have done it over here. All right.
Okay, sir.
If you just draw that chart, you'll get the correct answer. Okay.
Okay, sir.
Yes. Any other oral doubts, friends? Then I'll go to the SMS doubts once the oral doubts
Yes,
are
sir.
over.
Question number 38, B part also, sir.
38, is it? 38.
Yes, sir. Second part.
Okay, 38 is a beautiful question. Okay. The portfolio beta after 3 months, if he goes on a long position for 200 lakhs of Nifty futures. 1 minute. This is a very, very good question. Okay. We know the formula for beta as this one part is a good adjustment. Okay. Market is important. Beta, we know the formula is change in security return divided by change in the market return.
Yes,
right?
sir.
So we know the beta is 1.6. Okay. We know the portfolio is going to change by 3.2%. I believe that's given in the question itself.
Sir, it's given, sir.
It's given in the question, right? So from this, can I find out what will be the change in the market? So when you do a reverse working, you get the change in the market as how much percentage? 2%. So now what happens is you have taken 200 lakh long in Nifty future, correct?
Yes, sir.
This is going to fall by how much percentage now? 2%. So it will fall down to how much? 196.
Sir.
Futures is what, real or imaginary?
Imaginary.
Okay, but then you make a loss. 200 you bought, you're selling for 196, you make a loss of 4 lakhs. Real or imaginary?
Imaginary. That's real, sir.
Loss is real. Am I right? So
Yes,
the
sir.
moment you make a loss of 4 lakhs, what will happen is you had a cash of 30 lakhs with you.
Yes, sir.
That has come down to 26 lakhs because you lost 4 lakhs over there.
Sir.
So now you have a new cash balance, 26 lakhs, correct?
Yes,
okay.
sir.
And your portfolio, which was 170 lakh earlier, has fallen down by 3.2% now.
Yes, sir.
So your total assets become 190.56 lakhs.
Sir.
Correct? So your earlier the portfolio was 200, now it has fallen down to 190.56.
Okay, sir.
So you got a change in portfolio, you got in percentage, that turns out to be 4.72%.
Yes, sir.
So change in portfolio is 4.72, change in the market is 2%.
Yes, sir.
So your new beta will be 2.36.
Okay, sir. Understood, sir. Thank you,
But
sir.
this is a very tricky one. Now we can do this in our own method also, you'll get a different answer.
Okay, sir.
So there are two opinions to it, but this is how your textbooks have done it. All right.
Okay, sir. Thank you, sir.
So I think I can add a bit more of logic in this part so that everyone can understand what we are doing here, right?
Yes, sir.
Yeah. All right. I'll just note it down.
Excuse me, sir.
1 minute. 1 minute. Yes. With whom am I speaking to?
Brinda, sir.
Yes, Brinda. Tell me.
Sir, in question number 33, please take question
1
number
minute.
33.
Okay.
Sir, in this question, actually the question is asked about whether K Limited should change the composition of its portfolio, which means we have to find out the alpha, whether they have to buy or whether they have to sell. But in
Correct.
this term, they have find out something called theoretical beta. Why
Okay.
they find out
Okay.
theoretical
I
beta? What was
understood.
the
This
purpose?
question is actually an illogical question. Answer is not logical. All right. Here, actually, the question is very simple. First, they're asking you are required to calculate the risk of K Limited short-term investment portfolio relative to that of the market. Correct. So, ideally, what is related to that of the market? Beta only.
Yes.
You get beta, that should be the answer. But here, what they have done is they have found out two things: required beta, actual beta, 1.4 to 1.46. Then they will tell you actual beta is more than required beta, hence it is more risky. That answer is absolutely nonsense. By heart this question. Okay, this is not logical. Second thing, what they have done is they have been given dividend yield over here. Okay, they have assumed the dividend yield to be the return. The returns formula is what? P1 minus P0 plus D1 divided by P0. Am I right? They have ignored P1 minus P0, assuming that P1 and P0 are one and the same. And that's how they have found out the alpha in this question. That's also incorrect, because when they take alpha, you should not take your yield alone. You should take your actual return. But they haven't considered that. So this one question, you ignore it, or you can call it as a by heart question. Okay?
Okay.
But I'm forced to give the same answer here because in exam, that's how you get marks. Right?
Okay.
Okay.
Sir, then question number 37, sir.
1 minute. Okay.
Sir, in the question, it was given that specific standard deviation of expected return. This would be taken as a diversifiable risk in the answer, sir. So how should I know that specific ST is a diversifiable risk?
Okay, I'll tell you, diversifiable risk has got multiple names such as random error. Okay. Then they sometimes call it a unsystematic risk is sometimes what they call it. Sometimes they call it as residual variance. Multiple names they use. Here they use the word specific standard deviation.
Okay. It is another term.
It's another terminology, yes.
Sir, then final doubt, sir. Question
But that's
number
actually
33.
a very valid point. This terminology was used only in your November 2019 exams, not anytime before. So suddenly when they come like this, you might get confused. But see, you be prepared. Like that, some atom bomb questions will be there in every exam. Okay. When they give you a 100-mark question,
Okay.
10 marks to 15 marks is atom bomb. You can attempt 85 properly. That you attempt correctly, they'll give you full 85 out of 85 also. Okay?
Okay, sir.
Next.
Sir, last doubt, sir. Question number 32.
32. Okay.
Sir, in that, the last conclusion part, sir, the third requirement, whether the new beta justifies increase in the value of equity on account of leverage.
What is the answer they have given over here?
They have given, yes, it justifies the increase, lead to increase in the value of equity due to increase in beta. I don't understand what they tell, sir. Can you
What
please
they mean
explain
over
that?
here? Okay, wait. Whether the new equity beta, what was the original equity beta that they had? I think it was 1.496, correct?
No, sir. Beta equity is 2.20.
Initially,
That
is
is
it?
over. Yeah. Please come down, sir. Please come down. Please come down, sir. Next page. That was the equity beta, sir. First 2.20.
Okay, revised equity beta is turning out to be how much?
3.035.
So beta is going up, am I right?
Okay.
New equity is 3.035. This came in RTP. Which question has it come in? RTP May 2021. All right. So now when the revised equity beta, you got 3.03. So the risk has gone up. In one way, you say risk has gone up. Then it justifies the increase as it leads to increase in the value of equity due to increase in the beta. One minute. So the new equity beta justifies increase in the value of equity on account of leverage. 1 minute. Okay. They're asking whether have they increased the value of equity over here?
No, sir. Actually, equity value is reducing. That's why I'm asking.
Equity
They
value
buy back.
as it leads to increase in the value of, but why they are saying it leads to increase in the value of equity? 1 minute. Let me explain to you. Basically, what happens is when your beta increases, your risk increases, correct? When your risk increases, your CAPM return also increases.
Yes, sir.
So that means your discounting factor goes up. So when the discounting factor goes up, actually your value starts coming down.
Okay.
So when your beta increases, it's always good to withdraw some money from equity and invest in debt.
Okay.
Because debt has got a beta of 0.
Okay.
So your overall beta will come down.
Okay.
So your discount factor will also come down, and if it comes down, your value will actually go up. This is the original logic. Okay. But I'm not sure what they have done in this question. I need to work out this question once more. I worked it out long back. So basically, are they increasing their debt or are they increasing their equity?
Actually, they're increasing their debt, sir.
So when they increase the debt, what will happen is their overall beta will come down.
Okay.
Okay, so when the overall beta,
but in this one, we have taken the overall beta for both the scenario as same because our total investment remains the same, sir.
yeah, but here they have told increase as it leads to increase in the value of equity due to
Yeah,
increase
that's
in the
what
beta.
I don't understand, sir.
You do one thing. I think this is a sentence copied from the textbook or suggested answer. I'll give you a better wordings over here. Okay, we can just put it this way. Right? Increase in beta will increase KE. Hence, investing in debt will reduce overall beta, which will reduce WACC and increase value. Okay, we'll put it this way. All right.
Okay.
Yeah. Now clear?
Thank you, sir.
Thank you so much. Yes, friends. Any other doubts?
Sir.
Yeah, tell me.
So in this question number 24.
1 minute. Okay.
Yes, sir. In the table format, could you please take the details in the table just below that?
Okay.
Asha, the next year details, the dividend paid for the next year is 2.5 rupees.
Okay.
So it is inclusive of the growth rate, sir, right? It's D1, right? D plus 1 into 1, D into 1 plus
No. I
1,
think
right?
what they have said is dividend paid or anticipated per share. So this is D0 for the current year, this is D0 for the next year. That's how they have worked it out.
Oh, okay, so that's D0 for the next year. Oh,
D0 for the next year. So when you take it from the next year perspective, it is D0 like that.
okay. Thank
Alright.
you.
Shall I go to the written doubts now, friends? Alright. I'm going to the written doubts now. So I'll start with you, Harsha. Harsha, can you please unmute and speak to me? Question number 12.3 in the mastery book, it's asking for systematic risk, but the answer is calculated for systematic variance. Okay, Harsha, that one problem is there in your ICA study material. Many a places they have mixed up the words. They have used the word systematic risk, but they end up finding systematic variance. That is very, very frustrating, unfortunate. So what we'll do is you stick to how I have taught in the class, Harsha. I believe you have attended my class, right? So I have used a pattern where I give you correctly risk and you do it like that only. Stick to that method. That is better. Okay.
Okay, fine, sir.
Thank you so much. Thank you. Malini, you have a doubt on question number 12. Let me take question number 12 now. If possible, please unmute Malini so I can interact with you and clear your doubts. Yeah, Malini, what is your doubt? This is a very, very good question. Can you tell me what exactly is your doubt? Malini, I might need your help. You will have to unmute and speak to me. Ramdas, can you explain question 28, page number 5.146, standard deviation calculation? Question number 28, this question number 35. Okay, wait, let's start with question number 28. Ramdas, are you there? Can you unmute yourself?
Hi, sir.
How are you, Ramdas?
I'm good, sir. How are you, sir?
I'm good. Just give me a minute.
So I think 28 you already explained, like that is the sharp index model method.
Okay, so that part is clear, right? Okay.
Yeah, and question number 35, there is some term called like reward to volatility ratio.
Let's check.
Is that...
So that one useless question is there. I think that's 35. I am also trying to find the logic of this one question. Yeah, this question is simple. Okay. This question is very simple, Randa. This is reward to volatility ratio is nothing but Sharpe ratio. RP minus RF divided by standard deviation. We have learned it in the chapter of mutual funds.
Okay.
That's called as reward to volatility. That is, RP minus RF divided by standard deviation. Volatility is standard deviation. Got it?
Okay, sir.
Right. All right. Fine.
And this question number 12, which you were discussing before, like even I didn't understand that question, sir. Can you explain that question full?
1 minute. Question number 12.
Yes, sir. It's in page number 5.119.
12, right?
Yes, sir. 12.
Okay. You want me to explain the whole question?
If you don't mind.
It's a bit difficult to explain the whole question, but this is a very lengthy question. Yes. How do I'll do one thing, Ramdas.
Yes,
I'm actually planning to, once I'm going to Kochi for my one more class that will get over by in 10 days of time. After that, I'll be doing a list of tricky problems in each chapter. Like, for example, there'll be a YouTube video with the name of tricky problems in portfolio management or one tricky problems in. So in that, I will cover this one question so that all the heavy problems you can all have in one particular place. All right.
Sure.
Yeah, it will be very difficult to explain as a part of a mentoring program because this question is very lengthy and it's a very, very good question. I would just give you one suggestion, Ramdas. In my class, I have done a question where we had the new formula for covariance. And we had A, B, C. We were asked to find the beta, combined risk, covariance. After that, we did systematic, unsystematic risk. I told it's an ODB question. I'll tell you which one. After doing that, if you do this, you'll be able to connect it much better. This question, not this one, I'll tell you. This question, this one, question number 10. Okay.
Okay, sir. I will try
Okay,
both
just
the
try it out.
steps.
Otherwise, afterwards, once I get back, I'll do this as a tricky problem separately. All right.
Sure, sir.
Okay.
Thank you.
Fine. Thank you, Ramdas. Thank you so much. So I think Ramdas, your doubts are also clarified. Malini, are you there
Yes.
or are you left? Sumukha, ODB book beta getting 0.85, but solution it's different. 1 minute.
I think covariance of is 205.06.
1 minute. Page number, mastery book or the other one?
ODB books.
ODB book page number?
12. 7th question.
Question number 7. Okay.
I did covariance by using statistical. I'm getting 205.06.
Wait. Yeah, they have not found covariance. They have used the other method, is it?
Yeah, 289. In that they have used 289.
What is 289?
Same as covariance.
Where is it given 289?
Tops in the beta calculation.
No, beta calculation is an XM. That is 508. It's not 289. This is beta formula 1.
Yeah, I did the beta calculation by using statistical formula, covariance divided by variance.
Okay, do one thing. Send me your image. You would have done some mistake over there. Since there is no, did you divide it by 6 or 7? 1, 2, 3, 4, 5, 6. You should divide the total by 6. Did you do that?
Sir, in that, yes, actually, 2 is there, no?
You're not clear. I'm speaking to Sumukha. Right? There's some breakage in the voice, or your voice is breaking in between.
Sorry, here for 2 is there, but while calculating a negative figure will come.
Okay.
2 minus 6.33 minus 4.33 will come. That figure difference will come.
Here they have taken minus 4 over here, is it?
Yeah, 4 minus 4.33 for x minus x bar.
Okay. But I don't think that alone is the reason for such a big difference. Hold on. The beta answer is correct. 1.202 is the beta answer.
Yeah, sir, x minus x bar and into y minus y bar, it getting minus 42.22. So that same is getting difference here.
Okay, so then you have done it correctly, right? Did you get the answer as 1.202?
No, sir, 0.85. Beta is 0.85.
Something is wrong. No. Then you have done some mistake. Do one thing, send me the image in WhatsApp. I'll get back to you. Okay?
Okay, sir. Sure, sir. Thank you.
You will get the same number. Maybe little difference is okay, but you will not get that kind of difference. Okay?
Okay, sir. Thank you.
All right. Thank you. Yes. What is the one way next out? I think Sumukha's doubt is clear. Security valuation. Shivani, you have a doubt in question number 3, practice questions in the mastery book? Okay.
Yes, sir. Sir, actually, the doubt was in bond valuation question 3 of mastery book.
Okay.
Sir, in that
Shivani,
question.
just give me one moment. Let me finish off the portfolio doubts first. Only 2 more doubts are there. All right. Then we can get back to the security valuation. Is that okay?
Yeah, it is fine, sir.
Yeah. Okay. Now, Anugraha, share valuation. You have also share valuation. I'll come to that part. Okay. Sukesh, in one question while calculating alpha, ICA considered beta as 0. If in exam alpha asks, what should be done? Sukesh, in one question, ICA cannot simply consider beta as 0. Sukesh, can you share with me an image of that? There must be some reason behind that. Okay, I will now take the mastery book. We are talking about first bond valuation, right? Yeah, Shivani, what you told me? Question number 3, is it?
Additional question, practice questions.
Question number 3, right? This is question number 19. But I'm not sure if these are additional questions. Wait. Okay.
Like practice questions.
Question number 3. Okay, yeah. Got it.
Sir, here in the working note 1, sir, here we are supposed to find out the present value of the amount which we have to invest right now.
Correct.
Is my understanding correct?
Correct. Correct. Present value only. Correct.
Yeah, I didn't get through this formula, sir. I didn't understand how did we get 1.2x.
Ignore the formula. You just 1 minute. How you got 1.2x? I'll have to check. It should be 8 into 3 by 12 is 2, right?
Yeah,
8
yeah.
into 3 by 12 is 2, so it's 1.02x. Correct. It's not 1.2, it's 1.02x.
Okay. 8
That's a
into
typing
3.
error. Okay, I think I got your point. This is supposed to be 1.02x.
Okay.
Then you work it out, you'll get the same number.
Yeah,
That is nothing but the
Okay.
present value. Okay.
Yeah.
All right.
Thank you, sir.
Thank you. Thank you so much. I think one more doubt is there, friends.
I had another doubt, like it is a generic doubt.
Okay.
Like how many points, how do we get to know whether for how many points should we take that rounding of figure and all in the
Two
present
decimals
value
is enough, Shivani. 2 decimals is more than enough. Okay. Except if you're doing if you're doing a forex question, you might take a 4 decimal or a 6 decimal. Otherwise, 2 decimals is more than enough.
Because when I was solving, sir, a few questions had a different answer, rounding off.
You
Because
will
maybe.
never lose marks because of rounding off. I can be sure about that.
Okay, okay. Only this was my concern, sir. Thank you.
Thank you. Thank you so much. Okay. Now, I think one more message-based doubt was there. Share valuation, question number 30 in Mastery Book, stock lending scheme. Anugraha, that's a very good problem. I will do that as one of the tricky problems. I'll just slowly explain to you now. I'm not sure how much you will be able to understand, but I will explain that to you right away now. Okay. Share valuation, right? So that is that's dividend policy. Question number
30. Last question.
Last question, is it? Yeah, that question had come once in RTP. In stock lending scheme, what happens is if I have a share, I will lend my share to you. Understood? So when I lend my share to you, I am a lender. As a lender, I should be receiving interest. Correct? So here they have given the cost of bank guarantee, etc. is given. And other fellow, what he will do is I'll just draw a diagram and quickly explain to you. Suppose you are having two people. The first fellow's name is A, second fellow's name is B. A will do what? He will lend shares to B. What B will do is he will short sell. So what do you mean by short sell? He will sell today and buy later. After buying later, he will give it back to A. Are you getting my point? So what will A get over here is A will get the lending charges. Plus A will also get the dividend. What about B? B will get the gain or loss on what? He will get the gain or loss on short selling. Are you all clear with this part now?
Yes,
okay.
sir.
This is a concept. Now when you look at this, see they have taken the lending fee over here. So they get the earnings per share. Dividend income will go to the lender. So lender will get lending fee. He will also get dividend. But the gain on short selling of shares will go to the other fellow. Are you getting my point? So he will be getting 101. This is the earnings of the lender. In this case, the short seller is either making a loss or he's making a profit over here. Are you clear with this part? That's what they have done in this particular question. Now you go through it, you'll come to know better. All right?
Thank you.
Thank you so much. So I think, okay, Pranav, you want me to explain to you explain about downside risk. See, that concept is very simple. Downside risk means suppose the price of the share is right now 100. Tomorrow the price is going to fall down to 90. So what is the percentage of downside risk? Can you tell me? It will be 10%. Correct? That is the same concept that is used in your question, in your that question also. Okay, Pranav? Keeping this concept, just work it out once and get back to me. All right. All right, friends. Are you all done till here? Have I cleared all your doubts right now? Yes? Fine. So let's, I think we have done your assignments and we have reached over here. Now let me just talk about a simple concept which I had also shared in your WhatsApp group. I'm not sure if you went through that concept. This concept is called as the concept of the micro wins. Friends, if you want to be successful in life, we don't have to do big things. If you really want to be successful in life, do small things, but do it with victories. Small cumulative victories together ends up becoming a very big and a very huge level of victory, friends. So when I tell you do one assignment at a time, just focus on that one task. Break it down into smaller tasks. Do one part, finish it, celebrate the success. As and when you start doing these things, small victories come your way. Every day you do 2, 3, 4 small victories. Over a span of 1 month, you end up doing 100 small victories. This 100 small victories becomes one major victory, friends. And that is how we actually become extremely successful in life. So my request to all of you is, from today, every single day, write down and try doing at least 5 micro wins. These can be each of 1 hour each, more than enough. But make sure you write down these micro wins. If you do this in a month, how many days are there? 30. What is 30 into 5? Do you end up getting 150 micro wins? Friends, 150 micro win is nothing but it is one major victory. Like this, bit by bit, you will go forward. Bit by bit, you will complete your task. Bit by bit, you will become successful. So my request to all of you is, follow my mentoring program strictly. Do all the assignments strictly. I assure you, friends, coming May 2025 examination, you will score 70 plus, and that is the day when even I will celebrate along with you. All right, let's pack up our session with this, friends. It was a wonderful time with all of you. Be in touch with me. I will see you next Monday again to clear all your doubts so that we can study together, we can win together. Take care, everyone. Good night. Have a nice time. Thank you, everyone. Good night.
Thank you, sir. Good night.